Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Bloomberg Quint Live. HPCL reported an inline set of numbers with the quarter being aided by higher inventory gains. To give us more details about the quarter gone by, joining us now is the Chairman and Managing Director of HPCL, Mr. MK Surana. So, sir, in the first quarter was aided by higher inventory gains, but bearing that, both the refining and marketing segment remained weak compared to last quarter. So what led to that?
I don't know how you are saying it remains weak as compared to the last quarter. Last quarter, if we compare the quarter to quarter, the Q1 of 17-18 versus Q1 of, let's say, 18-19, last year we had a profit of 925 crore versus this year we had a profit of 1,719 crore. Last year we had a GRM of $5.86 per barrel versus that we had a GRM of $7.15.
That,
we had a market growth of 5% and we had done the highest market volume of 9.63 million metric ton this year. Now if you are saying just the previous Q4 versus Q1, it is more or less in the same range as far as the profits are concerned. But the reason is that even if you say Q4, the Q4 of 17-18, the GRMs were $7.07 versus this time it is $7.15. But there is a difference in the set of conditions in the sense that the exchange rate has gone up from $65 to $68. Then the crude price has gone up. If Q1 of last year to this year, it has gone almost from $49 to $74 or something like that. So at the same time, the cracks has gone down, especially on some of the products. So you have to have the set of conditions and which how the numbers come that we need to see, and to that extent, in a challenging quarter, it is quite a good number.
The core gross refining margins in the first quarter was around $3.72 per barrel, that is removing the inventory gains. But what led to such weak gross refining margins in the first quarter? Because if you see the Singapore gross refining margins, they average around $6 per barrel.
The Singapore gross refinery margins are based on the same day crude and same day products. That's number one. Second thing is Singapore GRMs are based on only 4 or 5 products. That is not on the complete basket of the products. So it cannot be compared one to one. When we report the GRM, it is based on the actual sales revenue which we get minus the actual cost of the crude and etc. what we spend. So there is a time element in this. For example, if you are on the eastern coast, there will be a voyage time of almost 40 days. Now during the 40 days movement will have some impact on, especially on the exchange rate in the system. The ERV itself will be to the extent of around 300 crores. The exchange rate variation which happens between from the date of bill of lading to the date of actual usage or process of that crude. The second thing is that as far as the cracks are concerned, if you see in the current quarter, these cracks are lower by almost $3 to $3.4 compared to Q1 of the last year. The third element is when you have got a crude at a higher price, then the fuel which you burn in the refinery will also be valued at a higher price. If we normalize for the lower cracks and the exchange rate, the actual GRMs are in line with what it was there earlier. In fact, the refineries had operated equally efficiently. Our volumes are higher than the last year quarter. Our capacity utilization is almost more than 110%, and the energy efficiency is also reasonably good.
So how do you see the refining segment panning out going forward?
As far as the product cracks are concerned, there is some recovery in this, especially on LPG and MS, because these two products, even in bitumen also, which has gone quite low. HSD is maintaining where it was. So we think that the GRM should be there in the same range of 6.5 or 6 or that like.
Now in first quarter, the marketing segment, if you remove the inventory gains out of the marketing segment, was a bit lower compared to the last quarter, and that was because of weak fuel margins that we had seen in the June ended quarter. Now so far in Q2, the fuel margins have remained more or less stable. So what is the outlook when it comes to the marketing segment?
No, if the crude prices are lower, which has come down, retracted from around $80 to $72 or something like that, then the capacity of oil marketing companies to absorb, to pass on the actual cost will be much higher, and to that extent it is better for the marketing companies if the crude prices remains low.
Actually, my next question was on that only. Now, we have seen a sharp decline in crude prices. In fact, Brent crude is now again below the $73 mark. So, does this sharp movement in crude also mean that there could be some inventory losses in this current ongoing quarter?
No, it is more towards the time you purchase the crude and the time you need to process, and actually what happens in the later part of the quarter. Means how many inventory you are holding at the end of the quarter, because during the quarter there may be some part may get adjusted, but in the last days of the quarter how it happens, whether there is a decline, whether there is an increase, and whether you are holding how much inventory of products, crudes, intermediates, that may have an impact on the overall inventory gains or loss. But still we need to see, it is early now, we are on 8th August, 9th August, and it's still almost 45 days to go.
Now, earlier we know that oil marketing companies had cautiously not revised the fuel prices to benefit the consumers given the higher Brent crude prices at that period. So, does this fall in crude prices to below $73 mark give you more room to increase your marketing margins going forward?
No, I had mentioned earlier also, it is not that the companies make the huge margins when the prices go low or that type of thing. We have got a way of calculating the domestic prices based on the international product prices. International product prices has got an element of product cracks and the crude prices. There is a possibility that the product cracks may not move in the same way as the crude prices are moving, and also there is third element of the exchange rates. The sum total of that decides the domestic prices, and there is an element of margin for the oil marketing companies. If the crude prices are lower, then the room for oil marketing companies to pass on the full cost to the market consumers is there, and more conveniently it can be done. If the crude price is very high, there is sensitivity of the customer which comes into play, and that we need to see what is our long-term view of the pricing, whether it is a spike, whether it is a momentary turn, or it is a long-term sustaining. And if it is a long-term sustaining higher prices, then we got no choice but to pass it on. We can only even out the impact of the pricing. We cannot actually absorb the pricing impact for a longer term.
Now, yesterday, as you mentioned, that so far HPCL has imported around 0.43 MT of oil from Iran out of the 1 MT oil that was contracted for this financial year. So, will the company be importing the balance, or will it cut down its imports from Iran?
We'll see as the things develop. There are discussions in progress at various levels, and we will see as it goes. As I mentioned, we have got a smaller component of Iranian crude in our basket. So, and we have taken some quantity already. There is some quantity balance, and in the remaining part of the year, we'll see how it goes.
Now, ONGC board has approved the restructuring process, and the first likely thing that will be happening is the merger of HPCL and MRPL. So how will this merger benefit HPCL as such?
No, it will bring a lot of synergy, because the MRPL is standalone refinery. We sell more than what we actually produce on our own refineries. So it makes an integration to the refinery marketing business volumes. That's one. Second thing is, all the three refineries, we can optimize the intermediate stream disposals. Each refinery will have some cushion in some of the units, but that can be realized only if we have got some primary capacity somewhere else. So we can see the better optimization in these. The economy of scale can be achieved in crude procurements, the logistic cost, etc. And we can utilize, leverage our R&D facilities. We can have the pool of resources of skill sets, which we can use it more efficiently. So there are efficiencies which can be built in. There can be synergies which can be advantaged and leveraged. In my opinion, it will be a good thing to do.
Lastly, sir, for how many areas has HPCL submitted bids in the 9th round of city gas auction, and has the company received any LOI from the PNGRB for any of the areas?
No, so far they have not sent the LOI for any area so far. They have opened the bids and they are being evaluated, and then they will be sending the LOIs. But for right now, I don't think they have sent LOIs for anybody.
No, they have sent LOIs for few of the areas. So I just wanted to know for how many areas has HPCL put in bid?
We have bid for around 21 areas. I'm also aware that lot many competitors have bid quite aggressively on this. But we have got an understanding of the business and we have bid according to that. And it depends on the others' understanding of the business and their strategies on that.
That will be all, sir. Thank you for joining us on Bloomberg Quint.